Hello and welcome everybody to today's special edition of Mexico News Network's Breaking News Business. I'm your host, Elliot Bullman. Remember to follow us on all our social networks and to catch us every day by logging onto our website, mexiconewsnetwork.com, for relevant stories and news. Let's start with today's show, focusing on Brexit. On the 23rd of June 2016, the decision of the United Kingdom to abandon the European Union was made public, and with it, the world's financial markets and currencies went into chaos, and Mexico was no exception. One might think that there's an enormous volume of trade between our country and the United Kingdom, but this is not the case. In 2015, Mexico's exports to the UK represented $1.967 billion. This amount represents just 0.5% of total GDP exports. With respect to imports from Mexico from the United Kingdom, we see a similar volume. By 2015, our country recorded imports from the UK of $2.34 billion, a figure that represented 0.6% of the total in the period. So if bilateral trade is so low, why does Brexit affect us so much? Well, the concern lies in the huge amount of foreign capital that is invested in Mexican short-term debt instruments and stocks listed on the Bolsa Mexicana de Valores. According to figures from the Bank of Mexico, to the 31st of December 2015, holdings of government securities by overseas investors was worth 2.125 billion pesos. However, by the 15th of June this year, the amount had fallen to $1.93 billion, a decrease of 9.2% in just 6 months due to capital outflows. Most significantly, the size of investment in the hands of foreigners represents 57.5% of the total of Mexico's international reserves. Global economic events like Brexit cause international investors to seek refuge in safe investment havens, denoted in currencies like the dollar or the Japanese yen. We could yet see many billions of dollars taking flight from the Mexican economy, which would cause further harm to the already weakening peso, as has been happening almost uninterruptedly since April of 2013, when the exchange rate was 12.14 pesos to the dollar. So in response to this, what economic measures need to be taken to make Mexico less vulnerable to foreign events such as the Brexit or even the threat of a rise in interest rates by the Bank of the Federal Reserve of the United States? Firstly, as an alternative economic protection measure, it's not advisable for the Bank of Mexico to increase the interest rate. And I point this out because it's not a good option due to that it won't solve the underlying problem, which is to deter capital outflows. This would only slow down Mexico's economic growth even further by its negative impact on productive investment, private consumption, and construction and public spending by having to pay more interest on the public debt. The real alternative to make Mexico less vulnerable to external shocks is to generate our own currency, so we're less dependent on the arrival of foreign portfolio investment flows. In fact, the reason why the exchange rate didn't reach 20 pesos per dollar on Friday, June the 24th, was because before the Brexit, analysts predicted that the Fed would not increase its federal funds rate in the rest of this year, which in turn alleviated pressure on the Mexican peso. Mexico's goal for the medium term is to greatly increase its exports, which translates into an ever-favorable trade balance. Since 2012, Mexico's trade balance has gone from positive to negative. In 2012, the trade balance recorded a surplus of $18.4 billion. But for 2013, the balance was negative $1.95 billion, and by 2015, the deficit had climbed to $14.609 billion. The trade deficit in the first 4 months of 2016 was $6.064 billion. So the expectation by the end of this year is around $18 billion. Obviously, a great part of the commercial deterioration is attributed to the fall in the price of oil since 2012. But another major factor is that export manufacturing at the state level has been falling drastically. By 2015, manufacturing exports grew just 0.7%, and in the first 4 months of 2016, this sector already shows a cumulative drop of 4.3%. It's important to emphasize that Mexico is ideally positioned to take advantage of the opportunity presented by the depreciated value of the peso and should seek new export markets while limiting imports, mostly those coming from Asia, which has caused a trade deficit of $119.5 billion up to the end of 2015. The commercial relationship with Asia is a major reason behind the slowdown in Mexico's economic growth. Another issue is that spending by the federal government that supports exports via ProMéxico is virtually non-existent. So unless they have support from state governments, companies are alone in their attempts to make inroads into foreign markets. By way of conclusion, what we can say is that Mexico will continue to weather the storm of the international financial markets with much more severe effects than other nations because the country depends on foreign portfolio investment. This situation can't be resolved in the short term, but a serious plan is needed that seeks to turn Mexico into an exporting powerhouse. We have the production capacity to make it happen, plus an abundance of talent and skills. What's missing is the support and commitment from employers who are largely unaware of this matter, and statewide funding to support the commercialization of exports. That's all for this special report. Thanks for joining me, your host, Elliot Bullman. Until next time.